When it comes to M&A volumes, 2023 was always going to suffer in comparison to the last couple of years. Not helped by inflation, the tech sell-off, and another banking crisis, the first half of the year has seen far fewer transactions than the same period last year. That isn't the whole story. Truth is, buyer demand is as strong as ever. We have more current buy-side mandates than we've ever had, and pretty much every buyer we talk to is planning multiple acquisitions this year. That seems odd in the current climate. Bear with me, there are a few reasons why. Firstly, one of the biggest underlying drivers of M&A in this sector and many others is the need to keep pace with the evolution of technology. Obviously, that isn't slowing down, and so the search for contemporary skills and tech continues. Secondly, a noticeable number of buyers stayed out of the peak of the market, perhaps thinking it more prudent to wait for demand and therefore prices to normalise. But their strategic needs haven't gone away, and that's created a lot of pent-up demand that is now entering the market looking for better value. And thirdly, extensive private equity investment over the last few years has created a glut of PE-backed platforms that need to build and return value to their investors. They need M&A to drive those promised returns, and they can't afford to wait around. Many of those plans, by the way, were laid on the assumption that prices at the scaled end of the market would be sustained. They haven't, as witnessed by a couple of high-profile digital marketing groups that have recently shelved their refinancing plans after testing the water. So private equity-backed groups in buy and build mode need to be careful to maintain some arbitrage between the prices that they're paying and the price that they might be selling at in the future. Another group of buyers looking for better value after the peak. But ironically, with so many buyers in the market for agencies and consultancies at the mid to lower end of the scale, prices haven't come down as much as these buyers had hoped. And that's simply due to a lack of supply to match buyer demand, which is creating more competition for desirable targets. The main reason for that lack of supply is that a lot of companies have had a tough start to the year, with fewer pitch opportunities and clients across the board delaying or cutting budgets, especially in the tech sector. So that's creating more uncertainty over their 2023 forecasts, and so unsurprisingly founders are hesitant about starting a sale process. But in recent weeks there's been anecdotal evidence that those client budget constraints are easing, and there's generally a greater sense of optimism about the second half of the year. We've also seen more creativity in deal structures aimed at mitigating the impact of recent trading in the interests of persuading reluctant sellers to engage. So, for those founders that are considering their strategic options, the news is that there are plenty available. And whilst we won't see another valuation spike for the foreseeable future, in our experience, multiples are still trending ahead of pre-pandemic levels.